Hi everyone, welcome to Officers Adda 24/7 or Adda 24/7 JAIIB CAIIB channel. Today we'll be discussing AFM numerical sessions, questions from module A, B and C. So we'll be completing all the numericals from these three modules. I hope the results have been great with respect to I and IFS. How was your exam? I hope the audio and video is fine. Am I audible? Okay. So, we will quickly try to revise all the formulas and the questions. Correct? So, we'll be revising the formulas followed by one question to give a complete edge to all the numericals. Right? So, just let me know, are we all good to go? Also, I would request share the session among all your friends and colleagues, and if you are waiting for numericals, this is the last chance where we can give our 100% results. We can give 100% of our efforts, right, to get the results that we have been thinking of. So, are we all ready? Just share the session among your groups if you can. Okay. So, I think I have shared. Class timing, evening we will have it from 6. So, without wasting further time, let's start. So, Patel Transport acquired a truck on 1st October 2019 at a cost of rupees 4 lakh. The firm writes off depreciation at 10% original cost. Now, do remember, this is the trick. This was a previous year question where the method was not given in the exam. Now, we have to understand when it says writes off depreciation at 10% original cost. The word original cost represents which method? SLM, straight line method, right? So, the word original cost is a hint that it is a straight line method, right? So, which method are we going to use? SLM. Do remember, while you solve such question, pay attention when the asset was bought. Where they can play, where they can be tricky, numerical could be, they can change the date. So, like for example, this truck was acquired on 1st October. Our accounting year starts from 1st of April, ends on 31st March, right? That's our accounting year. So, we have to be cautious about it. It was bought in the middle of the year. So, the depreciation will be how much? Only for 6 months. It is a mock test. If you want to practice a test, you can do that. Now, what is the formula of SLM? SLM is equal to cost of acquisition minus salvage value. This is one formula divided by life of asset, or this is one formula. Other could be the percentage basis. So, basically cost of asset into percentage of depreciation. Now, it says that the asset was bought at a price of 4 lakh. 4 lakh 10%. That means 40,000. Correct. But this 40,000 is for entire year. And we are looking only forward for half year. So, this would be 20,000 for year 1. Year 2 it would be 40,000 and year 3 it will be 40,000. So, it would be 1 lakh depreciation at the end of 3 years. I hope that's clear to everyone. Okay. Moving ahead to the next one. A machine cost rupees 1 lakh, has a salvage value of 25,000 and a useful life of 5 years. Calculate the depreciation rate of this machine using the straight line method. Now, what are we supposed to do? We are supposed to calculate the rate of depreciation, right? Depreciation rate. So, we have to think of this. How do we calculate depreciation rate? Now, in order to calculate the rate, we need depreciation amount. Correct. We need cost of asset into 100. So, they have given us, they have not given us depreciation also, right? So, 1 lakh minus 25,000 divided by 5 years. So 75,000 divided by 5. This is the formula. Cost of acquisition minus salvage value divided by the life of asset. Now when I divide 75, this will give me 15,000. Correct? Now 15,000 upon 1 lakh into 100. 15% rate. Correct? Next one. A firm purchases a machinery for rupees 2 lakh. It is to be depreciated by 20% at written down value method. It could be diminishing balance method. It could be written down value method. It sold the machinery for rupees 1 lakh at the end of the year. What will be the depreciation in year third? Kept it third year for a purpose so that you are able to identify that, how do we move in this area, right? So, year 1, 2 lakh depreciated at the rate of 20%. So, our depreciation would be 40,000 and my written down value would be 1,60,000. Correct? Year 2. Now, the written down value is 1,60,000 into 20% would give me 32,000. So, 1,60,000 minus 32,000 will be 1,28,000. Third year, 1,28,000 again into 20% will give me 25,600 minus 1,28,000. 1,02,400. Correct? So, my third year depreciation would be 25,600. Right? This will be my depreciation amount in third year. Now, if they say total, I can calculate the total depreciation of 3 years. If they ask depreciated value, written down value, we can write it as this one. Okay, so also the names are important, that what names are being asked, so do not get confused. Then the next one. Company ABC Limited purchases a pen production machine. Machine can manufacture 10 lakh pens, after which it will be scrapped. The purchase price of the machine is rupees 1 lakh and the scrap value is at rupees 10,000. During the year of production, the machine produced 2 lakh pens. The depreciation amount in the first year will be. What would be the right answer? Now, this is unit of production method, which says, how do we calculate it? Now, we have actual production of the current year divided by total production. This is the way to allocate the depreciation into cost of acquisition minus salvage value. So, how much have I actually produced in this year? It is 2 lakh pens. 2 lakh banaya na? That is 2 lakh. And kitna? 10 lakh. Correct. What is my cost of acquisition? What is the value? One lakh pen minus 10,000. So 20% basically, right, of 90,000 will give us 18,000. Correct? That's option number B. I hope this part is clear to everyone. That's how we calculate production method. Right? Production method, we focus on the unit of production. Kitna produce kara hai. Then, using the sum of the year digit method, calculate depreciation for all the years of a rupees 10,000 machine with a rupees 500 salvage value and a 4-year useful life. Now, 4-year useful life means, and all of you are aware that we have a marathon class today evening 6. Now, the life of the asset is 4 plus 3 plus 2 plus 1. How much it would be? 10, correct? And let's calculate it for the year 1. So, 10,000 minus 500, correct? What would be the proportion for the first year? 4 by 10. See, obviously year 1 when you would have bought it, you will be using it for proper 4 years, right? So 4 upon 10, year 2, directly I'll write it as 9,500. You can get it from here. 3 by 10, year 3, 2 by 10, year 4, 1 by 10. So like 950. You can also calculate percentage in it. $2,850 and 3,800. Like for the first year, the depreciation percentage would be 4 by 10 into 100. By any chance, if they're asking percentage, that also you can calculate. So that's 40%. Correct? So we can also calculate it in terms of percentage. Then, a student purchases a computer by obtaining a loan on simple interest. Correct? The computer costs 60,000 and the interest rate on the loan is 12% per annum. If the loan is to be paid back after 2 years, calculate the total amount of interest and the total calculate total interest and total amount. See, the purpose of the session is to keep you aware or help you revise all the formulas at one point of time, right? So the some questions could be very easy. Only the reason is so that you're able to recall the formula, you're able to recall the formula, right? And retain it and practice it. So a student purchases a computer by obtaining a loan on simple interest. The formula for simple interest is principal into rate into time. Now, what is the principal amount? 60,000. Rate is 12% and time is 2 years. Correct? Now, if it was in days, we will have taken 365 in the denominator. So, 60,000 into 12% into 2. 14,400, correct? And the amount will be, in case of simple interest, the amount is what? 74,400, right? Take rest after the numerical session and be ready for the marathon in the evening. Now, if the interest is to be compounded annually, which of the following will be used? This power wala thing is wrong, right? So, if you want, I'll write it properly over here. Right, it is like this, and this is also n. Principal 1 plus r power n. So from here we have started module C, right? Now, the formula will be this. This is for half yearly, and don't get confused. Half yearly, semi-annually, these are same words. Semi-annually, like annual, semi is half of it, then quarterly, this is monthly. What is the formula for continuous compounding? Somehow I always feel that it is important and should be asked. Like only the formula of continuous compounding. Yes, A is the right answer. What is the formula of continuous compounding? Very good. It is amount is equal to principal into exponential r power t, power r into t, sorry, right? So, this is the formula for continuous compounding. Okay, very good. Next one. This is a previous year question. I frequently cover this. Why? Because, with this you are able to calculate the future value. Compounding and discounting effect both could be covered in one particular question. So the question says that the population of an industrial town is increasing by 5% every year. If the present population is 1 million, estimate the population 5 years hence. Also estimate the population 3 years ago. So you not only are required to do the compounding, you are also required to do the discounting. And that covers all the concept of the same question, in the same question, sorry. Now, the formula of future value, the formula of compounding is same. दोनों same है, right? It is amount is equal to principal 1 plus r power n, and same is the formula for future value. Future value is equal to present value 1 plus r power n. The formula for discounting or calculating the present value or the principal amount is same. Amount divided by 1 plus r power n is equal to principal. Similarly, future value divided by same formula. We have just given it a fancy name. Correct? Now, while we are saying present value, future value, what does this word value means? What does the term value means? Value means cash flow. The term value here refers to cash flow. Now, the population is growing, right? So, if it is growing, it is increasing, that means compounding. Correct? How do we calculate it? The first thing is 1 million. 1 million means 10 lakh. Correct? So, 10 lakh into 1.05 and how many years? 5 years. You know how to do, how to calculate the power? That's future. And then they have also asked past data. Correct? Now, in order to calculate the past data, that means today the population is 10 lakh. Considering it as P, what it was, we have to calculate the population which is 3 years back. Today it is 10 lakh. What was the population 3 years back? So, 10 lakh divided by 1.05 power 3. Now, how to calculate the power? Always remember, power will be, we will press equals to 1 less, 1.05 into 1, 2, 3, 4. Stop here itself, no 5, correct, into 10 lakh. Answer will come as this only, no? 127,628,1.56. Okay, then in the next one, 10 lakh. Now, because we are doing division is always equal. 1.05. You can also calculate the power and divide it. Right. 1, 2, 3. 8 lakh 63,837.60. Correct? That's how you do compounding and discounting together. And you don't have to write so much of story in exam. Just do it directly. Then, the easiest one, I hope this comes for 2 marks, the rule of 72. What does it say? The rule of 72 says that how much time will it take to double your money? Right? So, how many years it would take for you to double your money? There is a trick to it. It works in the case of compounding. The rule says if you divide 72 by R, you will get the time in which your money will get double. So, my rate over here is 6%. If I divide it, this will be, it will take me roughly 12 years to double my money. Correct? We all should pray together. The mass prayers, I think I heard that this should come for 2 marks. And do remember, it's not used for simple concept, simple interest concept. It is used for compounding. Then, calculating the future value. We have already done the formula, the same thing that I was telling you in compounding. Let's solve a question. Mr. A Very good. I hope tomorrow we all will meet with such happy faces and you will be telling me that ma'am, we have calculated, we have cleared our AFM exam also. The marks won't matter. It is 50, 51, 52, 78, 89, 100. But yes, definitely that word that we have passed the exam will matter a lot. And I'm sure that I'll see many of you saying that tomorrow. See, we have done so many times, we have done revision. 5 to 6 times we have done revision. Right? I'm sure you will perform better. Now, just have confidence. Read the question very carefully. Don't try to misinterpret it. Right? Just be relaxed. Mr. A invested rupees 1 lakh at the rate of 10% compounded annually for 5 years. Calculate the amount at the time of maturity. We are required to calculate the amount at the time of maturity. I'm sorry, I'm sipping coffee, but I just want to keep my throat in a good condition till the eve. Now, at the time of maturity means they are asking us to calculate future value. Do you see words like at the end of every year or at the beginning of every year? You don't see such words. Why? Because it is not an annuity question. It's a one-time thing. So, future value. It's a simple question of future value. 1 plus r power n. Such questions are not even asked. Rarely they ask. They ask formulas of it. But we have to be prepared for everything. Power 5. So, simple question 160161051. I'm just copying one of yours answer. I think you would have done the calculation. Now, if it is, you write 1.10 in your calculator, press multiplication button and equals to button, you will press it how many times? 4 times. Then, Dinesh is likely to get 4,000 after 3 years. What is the value as on date if the time value of money is likely to change at the rate of 11%? Now, very simple, present value is equal to future value divided by 1 plus r power n. Now, again see, they have not used every year, it is a one-time thing, right? Beginning, nothing is there. I will do that. Just remind me once I'm about to end the session. So, 4,000 divided by 1.10 power 3. So, rupees 3,005. Then, now what is annuity? Annuity is basically series of payments. So, the keywords would be every year, regularly, correct? It could be either in the beginning or it could be at the end. If it is in the beginning, it is annuity, ordinary annuity. If it is at the end, it is annuity due. Now, annuity due basically talks about beginning and ordinary annuity talks about the end, right? So, the payments are made at the end of the year or they are made at the beginning of the year. If they are made at the end of the year, what does that mean? That you will get 1 less interest as compared to the beginning. So, always in the same formula multiplied by 1 plus r. Annuities are a series of fixed payment at a specified frequency, fixed period, everything is fixed, nothing would change. Now, let's see this. You will receive 1,000 at the end of each year for the next 5 years. Now, can you see the difference? At the end of each year, for next 5 years, you will keep getting this amount. Now, this and this. Each year says it is annuity and says it is ordinary annuity. Correct? So, there is ordinary annuity, correct? And we are required to calculate the end of 5-year period. That means they are talking about future. Though they have also given this in the question, future value, but they are talking about future. Now, what's the formula? This is one formula that you have to think of. This is the formula that you have to always remember. So, future value is equal to annuity amount into 1 plus r power n minus 1 upon r. Before I move ahead and I forget something, I'll just tell you this question that's very important. At times they ask for effective rate of interest. Effective rate of interest. I'll skip this otherwise. Effective rate of interest. The formula is 1 plus r power n minus 1. That means if you have a rate of interest of 10%, that is compounding quarterly. ideally you will not get 10%, you will get more amount, correct? So they want to ask that if my interest of 10% is compounding quarterly, what would be the effective rate of interest, right? This is the formula. Please mark it very important. It is definitely more than 10%. How do we calculate it? Now, 10% divided by 4, because it is quarterly, that means it would be 2.5. So, 1.025 power 4 minus 1. So, this is coming as 1.1038, right? 13 minus 1. So, that means if I convert it into percentage, it will be 10.38%. Correct? So, this is the formula for calculating effective ROI. Even in the marathon today, I will be covering a question from this, so that we get confidence. We have done it in revision class, we have done it today, we will do it in the evening also. Okay? Done? Then, now this is a very simple formula, we have already written it. Now it is simple, we need to just recall the formula and understand what are they asking. So 1.05 per n, that's 5 years, minus 1 upon 0.05. So this will give us 5525.63. Correct, everyone? Then, now if it is a question of annuity due, in the same question I will help you so that we save our time, because you need to relax first. So annuity due in the same question, right? If the question was of annuity due, I will read the question for you there. So what we have to do, the same formula. Future value is equal to annuity into 1 plus r power n minus 1 upon r into 1 plus r. Correct? Only difference would be that there will be one extra rate of interest. Correct? Just 1 minute. Can you see that? Now, just I think the values are same. If this was the question, 5525.63 into 1 point, what is the rate of interest? 1.05. So, our answer would come as 5801. Okay, see. Now, see this question. 1000 is invested at the beginning of each year. Correct? So, beginning means annuity due. Correct? Then, should we move ahead? Next one. You are to receive 1000 at the end of each year. See again, is it annuity? Correct? What is the present value of this annuity? You are required to calculate the present value. How do we do that? How can we calculate the present value? The formula of present value is equal to annuity amount into 1 plus r power n minus 1 r. Correct? Only difference is we will have to do this 1 plus r power n. Correct? Then, the annuity amount is 1000, 1.05 power 5 minus 1.05 into 1.05 power 5. Correct? The answer would come as, now if you are facing any problem with power calculation, just let me know. 1, 2, 3, 4. So see, when there is a present value thing, just copy down the power. So 1.2763. I do it so that it is easy for me. Though there are other ways also to retain it, but let's not, just let's simplify it. Is it coming 4329? Is it clear? Let's move to the next one. Now, present value of annuity due. Same question, same formula, we will do annuity due. If it was annuity due, what would be the formula? Now, annuity questions, they can be asked in exams, right? Same formula, annuity amount 1 plus r power n minus 1 divided by r 1 plus r power n into 1 plus r. Okay, this will not be visible, but somehow if it is, this is 1 plus r. One extra rate of interest that we have multiplied. Okay. Honestly tell me, you are able to recall all the formulas, no? Yes or no? You're solving it, you're not solving it, it is okay. You just even writing the formulas before I write them, I think that's a decent thing. 60 in PPB. Oh, that's very nice. Saurav Sarkar, very nice. 60 is a good score. Now, EMI. Now, how do we calculate EMI? Equated monthly installment. Just have confidence, don't get confused. So, EMI is equal to same formula of present value. What is the present value formula? Annuity amount 1 plus r power n minus 1 upon r, right? And 1 plus r power n. Now, what you have to do? We just have to, everything is fine, audio and video, everything is fine. So, if we are calculating EMI, the loan value, principal amount into rate into 1 plus r power n upon 1 plus r power n minus 1. That would be equal to annuity amount, same, just we are cross multiplying everything. This will come here, this will go upside. Let's try a question. A loan of 2 lakh at interest 12% per annum is to be repaid in 24 equated monthly installment. Calculate your EMI. Check your phone audio. You might have also slow it down because of exam, no? Now, the formula is EMI, we have to calculate. Just do remember the rate has to be converted into monthly rate of interest, right? It should be monthly. So, 12% will become how much? 1% for every month, correct? Then 2 lakh, the formula I'll just write it again. The formula is principal into rate, the cross multiplication one. I don't want you to mug the formulas, just think from where you can derive it. 1 plus r power n minus 1 is equal to EMI, correct? Now, 2 lakh into 0.01 into 1.01 power 24. 1.01 power 24 minus 1. Now, the biggest problem is how to solve such complex part. This is the easiest part. See, you can break 24 factors. I am doing it 6 into 4. 6 4s are 24, right? Now, instead of this, if it was 240, correct? How will we do 240? 60 into 4 is 240. Then what is 12? 6 into 10 could be 12, it could be 60. So, you need to break it like that. Okay, so you can break it into this way, or if you really want to put more effort, so 6 into 5 into 2 into 4. So one factor could be 8 into 6 into 5. So I multiplied these two and these two. Okay, now how do you solve these values? I'll show you for both of them. Now, for example, 1.01. multiplied by. So the first one is, we will do first 24. 1, 2, 3, 4, 5. Correct? Nothing. Again, just press this multiplication button and see the next part. That is 4, 1, 2, 3. 1 less than the part or the factors that we have computed over here. So my power is coming for this is 1.2697. This is the power that I am getting. Right, now how to solve it for 240? Now we are solving it to 40. What are my factors for 240? 8 into 6 into 5. This is what I have factored. Okay. Now see, 30 into 8 is 240, right? Now 1.01 multiplied by. The first one is 8. How many times I will press equals to? 7 times. 1, 2, 3, 4, 5, 6, 7. Again multiplied how many times? 6. So 5 times. 1, 2, 3, 4, 5. Again multiplied. 5 is there. How many times equals to? 4 times. 1, 2, 3, 4. Okay, that's how you calculate big powers also. We don't need it because in our question we need the smallest one. So 1.2697 into 0.01 into 2 lakh divided by 0.2697. 9415.65. Done? Then, a construction company plans to purchase a new earth mover for 3,50,000 in 5 years. Determine the annual savings required to purchase the earth mover if the return on investment is 12%. Now, you are required to calculate the annual savings. What does annual saving means? This means they are asking you for using the formula of sinking fund. Why? Because sinking fund is a fund that is created with respect to future value. I know that I have to save a significant amount, but how do I save it? What is the annual saving? We all dream of everything, right? We want to buy a house, we want to buy a car, we want to buy a bike or a two-wheeler or some gold thing, and there is an amount we need, right? For example, let's say I need 12 lakh to buy a car. So how much should I save today for the next 5 years, 6 years, 7 years so that I can fulfill my dream? That is what sinking fund concept is all about. You have to calculate the annual saving. Don't you think that's the annuity amount that you have to calculate so that you can have a particular future value, right? So same concept. Future value is equal to annuity amount into 1 plus r power n minus 1. Now I told you, if the question is silent, we will use the concept of ordinary annuity. So future value into r is equal to annuity amount see, do one thing. Once this session is over, I'll try to complete it as soon as possible. Try to take some rest. Okay, try to take some rest. Also during the night, please take rest. A rested brain performs better than a tired brain, right? So if even you know things, in order to perform in that way, please take some good rest of 6 to 7 hours. Now we need the, we know the future value 3,50,000. What is the rate? 0.12. 1.12 power 5 minus 1 will give you annuity amount. Correct? Now I think you can solve it. So the answer is coming as 55,093.41. That's my annual saving if I want 3,50,000, right, in 5 years. See, I don't know the time exactly. How much time will it take? It's generally like dependent only. But I think next max 1 hour, not more than that. What will be the present value of rupee 1 at 10% rate? In year 2, you have to calculate the present value. How will you calculate it? I think this was asked once. While the old syllabus, this question was asked. Not in the new syllabus, I've asked it in the old syllabus. Also, there is a mock test link that you can attempt, and there I will also share my my Telegram group link. If you are not connected anywhere with me, then do one thing. I know that that getting the it is there, marathon is there from 6 p.m. Not having a PDF makes you restless. That is why everything is there in my Telegram group. You just need to just check the previous messages. You'll find everything. So I will immediately post it in the Telegram group. If you are not able to find it in virtual library, you can just check my Telegram group. It would be posted. How do I calculate it? 1 divided by 1.10 and press equals to 2 times. All the modules. Marathon has all the modules. One divided by 1.10. Answer will be 0.826. Correct? Because what are they asking? If it is 1 rupee and it is the discounting we are doing for the second year, equals to, will press 2 times. Correct? Then, a bond whose par value is ₹1,000 bears a coupon rate of 12% and has a maturity period of 3 years. The required rate of return on the bond is 10%. What is the value of this bond? You are required to calculate the value of the bond. And if you like the efforts, please click on the like button and subscribe the channel. Also, Marathon Maha Revision is from 6 p.m. Okay. A bond whose par value is 1,000 bears a coupon rate of 12% and has a maturity period of 3 years. The required rate of return on the bond is 10%. What is the value of this bond? Now, how do we calculate? Again, just stay with me and you will understand. This is the easiest thing. Step 1, write the rate of interest. First, write the years. And third year, you will also get the maturity amount. Correct? It is like this, Manju. Just 1 minute. 1 divided by 1.10. 1, 2. Okay, Manju ma'am, I hope this helps. Now, 1,000 rupees is the face value, 12% is the coupon rate. Correct? So, what would be the rate of interest? 120, 120, 120 and 1,000 at the maturity period. Correct? Now, what we have to do? We have to do the discounting. What is the discount rate? Required rate of return is 10%. Now, how do we solve it? Just see over here. 120 divided by 1.10 equals to M plus. I am writing the value, you need not write in your exams. Then, another equals to M plus. If you're not able to understand M plus, don't do M plus. Just write the value. Just press equals to and write the value 90.16. Okay. Now, here the value was common. Correct. Now, 1,000 rupees we will receive in third year. The present value of this would be 1,000 upon 1.10 par 3. I need the third year value. Correct. So, how will I calculate it? 1,000 divided by 1.10. 1, 2, 3. This is coming as 751.13. Correct? No, 751.31. Now just add all these values. Try to add all these values. Okay? If you don't know the M plus trick, you can just add them now. You will get the answer. If you know the M plus trick, press MRC. What have I done? Wait, 751, I forgot to press M plus. 0.31 M plus MRC. You will get the value as 1049.73. So, you just have to add all these values together. Correct? You got the answer. Now, tell me, will you buy this bond or not? I am investing ₹1,000 today. Correct? What is my future value? Present value of future inflow of the same bond? 1049.73. It is greater than what I am investing. I'll go for this. Yes, I will invest. If the value was 900 something, will you invest? You shouldn't. Why? The present value is less than why we will. We will definitely see if the present value is less in any case, you should not go for it. Is it clear, everyone? Krishna Kumar, is it clear? Okay, moving ahead. Next one. The concept of current yield on bond. How do you calculate current yield? Current yield means current return. Correct? You need to calculate current return. How do we calculate current return? That is easy. So, current return or current yield is equal to coupon interest upon current market price into 100. Correct? So, if a bond is having a face value of 1000, carrying a coupon interest rate of 8%, now this 8% will be always calculated on face value and currently it is quoted at 800. You are required to calculate current yield. So, current yield is equal to 1000 into 8%, that is 80. Correct? So, let's put the value in the formula. 80 divided by 800 into 100 would give us 10%. Right? Then, consider a bond having whose current market price is 850. The bond carries a coupon rate of 8% and has the maturity period of 9 years. What would be the rate of return that an investor earns if he purchases the bond and holds until maturity? See, the team has already, see, if you are learning it for the very first time, yes, they are difficult to perform. But if you have practiced it long way, we have done them like 200, 300 times now. So many times we have practiced it. If you're trying recently, I think then it is one thing that you should skip then, because definitely these are higher questions. We have spent good time in paid classes to cover these. If it is new, if you're feeling it difficult, yes, it is difficult. There's no doubt about it. But practice makes things easier for everyone. And you'll see everyone is trying to answer also. Very good. See, and there is no running away from such questions. I keep telling you, see, this chapter will come back to you in CAIIB. I will not teach you, Praveen sir will teach you in BFM and Vishal sir will teach you in BFM. Same chapter would be repeated in BFM. Many of capital budgeting will be repeated in ABFM. I will teach you it. I'll teach you again. Term loan chapter repeat again in CAIIB. So these are the things maybe in JAIIB or CAIIB you'll have to learn it. Now, we are required to calculate the YTM. Right? Now, what is the formula of YTM? Coupon plus redemption value minus purchase price divided by life of the bond and average price of it. If it is cost of debt, you remember the difference. If it is cost of debt, then the ratio is 60:40. Right? 60% of purchase value, 40% of the redemption value. If it is YTM, then we use average value, that is 50-50%. Right? Now, the coupon amount is again 80. Now, what is the other difference that I am earning? I am also able to capture 9 years this difference and average of the price, because there are two values. I cannot take any one value. So, 96.67. Very good. Upon 1850 will be 925 into 100. So, 96.67 divided by 925 will give you approximately 10.45%. Correct? So, the YTM is 10.45%. Okay. Acha, tell me one more thing. If they ask you modified duration, what is the formula of modified duration? What is the formula of modified duration? Maclay duration divided by 1 plus YTM. Correct? That is how you calculate. Now, if I say you have a Maclay duration of 4.1 year, 4.10 year, correct, and the YTM, the new YTM is 6%. Can you calculate the modified duration? New YTM I am saying is 6%. Correct? So, how we will calculate? 4.10 divided by 1.06. 3.87 years. Now see, the relation between YTM and duration is also inverse. If YTM increases, duration decreases. Correct? There is an inverse relation. Then, see, our YTM chapter is also over. Current ratio is there, working capital is there. You are required to calculate current liabilities. See, if it is getting mixed, leave it. Just go and take some rest. Next one. Almost about to complete. I think it will take 45 minutes maximum. Current ratio is given, current liabilities we have to calculate. And trust me, you all can do it. Just have faith on yourself. Take rest. If you are tired, you can do it. You have already done it, you can do it. Think positive, everything will be fine. Current asset is equal to 50,000 plus current liabilities. Correct? Now, current ratio is current asset upon current liabilities 2:1. Now, let me place the value 50,000 plus current liability upon current liability. So, 2 times of current liability is equal to 50,000 plus. So, my current liabilities would be 50,000. And if the current asset was asked, it would be 2 times of current liability. It would be 1 lakh. So, the ratio of current ratio is equal to current asset upon current liabilities. Correct? Asset test ratio or quick ratio. Asset test ratio or quick ratio is the formula is quick asset upon current liabilities. Now, quick asset is equal to current asset minus inventory. Now, if they ask you the difference, you need to know that quick asset, the difference between current asset and quick asset is inventory. Right? Either way they can ask you. So, current asset minus quick asset will give us what? Inventory, unsold goods. Correct? Then, from the following, calculate the net profit ratio. Net profit ratio means net profit or profit after tax. Net profit is profit after tax divided by all these profit based ratios. Net sales into 100. Correct? So, my net sales is 500. My profit after before tax is 30 and my tax is 5. So, 30 minus 5 will give me 25 upon 500 into 100. I think that would be 5%. Correct? Now, can you calculate quick ratio also in this? From the same question, can you calculate quick ratio? Current asset minus inventory upon current liabilities. So 40 minus 10 upon 30. 30 by 30, that is 1:1. Correct? Very good. Calculate the average collection period. Average collection period is related to which one? It is basically the credit cycle that we offer to our customers. If I am selling goods on credit, my customer would repay my amount, right? The average cycle of repayment is that days, or whatever the answer we will get is that number of days, right? So, average collection period talks about the recovery of amount from my customer, whom I am selling the goods on credit. Correct? Now, the formula is, first of all, debtors turnover ratio. They can also ask you in terms of velocity, the same thing, debtors velocity ratio. So, debtors turnover ratio, the formula is, now my debtors are related to sales, that is credit sales, correct, upon credit sales upon average receivable, correct. Now, how much is my credit sale? Now, my credit sale is 1.2 lakh divided by, now see, there is no opening balance and closing balance. I'll take both of them, 30,000, correct. So, this will be 4 times, correct. Now, see the option. The question is asked in days. What will I have to do? I'll take 365 days upon 4. 365 divided by 4 is equal to 91.25 days. I can write it as 91 days. Correct? Done? Then, if the debtors turnover ratio is 4 times, average debt collection period will be? What will be your average debt collection period? Again, it is related to my customers to whom I have sold the goods on credit. Cash wale to already they would have paid. Now, it is in terms of month. So, 12 months divided by, again the same thing, 4. 4 times. 3 months. Right? Then, okay, wait. I have misplaced one question. I recalled it. I'll just come back to that question. You are the credit officer, so basically don't go with the theory wala part. It says that you are required to calculate the fixed asset ratio. Fixed asset ratio. You remember the satisfactory level? What is the satisfactory level for fixed asset ratio? .67 or less. Very good. Very good. See, you know everything. Why are you worried? That's a tougher thing. And you know it. Just have faith on yourself. So, the formula is net fixed asset upon long-term funds, correct, less than 1, and the perfect is 0.67 or less. Now, my net fixed asset would mean fixed asset minus depreciation plus investment in subsidiaries. So, this will be 1000 plus 200, right, both of them. And what is my long-term funds? Whether it is capital or whether it is debt, all have to be added. Upon 1300, this will give me 0.92, I guess, right? 0.92. Right? So, this is coming as 0.92. It is less than 1 and hence acceptable. That means some fund would have been also used from long-term sources. Long-term sources have been used for funding our asset. That is the right thing. Correct? Always my long-term sources or long-term fund should be more than the fixed asset. Correct? Then calculate debt equity ratio. Debt equity ratio. Depreciation will be subtracted, not added. It has to be subtracted. This is investment in subsidiaries. Fixed asset, it is all, because nothing is given, we will assume that it is net of depreciation. This is investment in subsidiaries. Net fixed asset here means fixed asset plus investment in subsidiaries. Calculate debt equity ratio. It is also called as leverage ratio. They are part of solvency, long-term solvency ratio. Long-term solvency ratios are used for long-term decision making. Correct? Also, turnover ratios are called as efficiency ratio and activity ratio. Now, debt equity ratio, as the name says, just put a line in it, debt upon equity. Now, how much is your debt? The key point over here is redeemable preference share. Is it more than 12 years or less than 12 years? If it is less than 12 years, it will come under the category of and if it is more than 12 years, then it will be added, it will be part of capital. That's the key thing over here. Right? So, debt equity ratio, how much is our debt? Now, it is less than 10 years, I will be counting it. 300 crore plus 50 crore. We are not doing the maths over here. I don't need the answer like that. I just need the formulas that you are able to put. 100 crore. Correct? Equal or less. Equal or less than 12 years, then it is debt. More than 12 years, it is capital. Okay? So, whatever our answer is coming, it is okay now. Now, we'll come back to the question that we have left. I'm sorry, I was not properly able to arrange it. Now, cross rate is calculated with the help of chain rule. Right? We use the concept of chain rule. What does the chain rule says? Whatever it says, we have a trick for it, right? The trick is you have to check your currency at left hand side. Check the currency at left hand side. If the currencies at the left hand side are same, we divide. If it is different, we multiply. Right? Now, let's see this question. The question says $1 is equal to rupees 74.8545 and $1 is equal to 0.9027. This is the value given. Correct? Now, left hand side, my currency is same or different? This is same. Correct? If it is same, then I am supposed to divide. What is asked in the question? 1 euro is equal to how many rupees? So, if they are asking me to calculate rupees, I will keep rupees in the numerator part. If it was euro, I will keep euro in the numerator part. Divided by 0.9027. 74.8545 divided by 0.9027. So, it is 82.92. Correct? Then, one more question, chain rule. Let's see, it might, okay, see the currencies are different. Just look at the question, the currencies are different, don't write anything, just multiply, directly multiply. 748450 into 1.2720. Don't waste your time doing anything else, just see if the currencies are different, just multiply, done. Correct? See, here and here, the currencies are different, the currencies at right hand side should be multiplied. Just try to save your time wherever you can. If the interbank rate in London is quoted as £1 is equal to something and then something, what is the spread in USD terms? Spread is basically, what is spread? Spread is basically your margin. Right? It is your margin money. So the difference will be 1.2720, 1.2740. How much it is? 0.0020. Correct? That is the margin. So bank is selling at this is bank's selling rate. Correct? And bank is buying at this rate. So that means this percent is bank's margin, profit or spread. Okay? Then, one more question was left. A firm has the following data for the financial year. Based on the data, calculate stock turnover ratio. I am assuming ki whatever the paper comes, the 90 marks or 95% paper should come from whatever we have read, right? Not only 10 marks. The 95% paper at least should be from what we have studied or what you know. Calculate the stock turnover ratio. The formula is cost of goods sold upon average inventory. Correct? Cost of goods sold upon average inventory. Now see, here you have two values, opening stock, closing stock. Here we'll do the average part, add them. $1,80,000 is coming, the average value. Sadhna ji, very nice. 57 is such a good score. So, कल भी बस मुझे ऐसे ही मार्क्स बता देना. 1,80,000. 5.71 times. Correct? Then, assuming the current ratio is 2, state in each of the following case whether the current ratio will improve or decline or will have no change. Now, if my current ratio is 2:1, correct? If it is 2:1, I am assuming a figure of 20,000 and 10,000. You can arrange a figure of anything. 2 lakh, 1 lakh, 4 lakh, 2 lakh, correct? Anything. Just we want to find it as 2:1. See, 46 is again, if you're giving all the papers, correct? And if you're scoring 45 to 49, you have a good chance. Just you have to stretch these 2, 3, 4 marks gap in one of the paper and you will be good to go. Trust me on that. So, we have done a payment of a current liability. How much? 5,000. Assuming at 5,000. What will happen? If I am paying my current liability, my cash will reduce by 5,000. I am assuming the amount as 5,000. Similarly, my current liability will also reduce. So, 15,000 upon 10,000. That means, 15,000, 5,000. That means the ratio will be 3:1. So, payment of current liabilities would increase my current ratio. Correct? 78. That's an amazing score. Then, purchase of fixed asset. Now, if you purchase fixed asset, there will be no impact on current liabilities, but my cash would reduce. Let's say I assume that the purchase is for rupees 10,000. Correct? At the moment, my current asset are 20,000 and I am giving 10,000 for buying a current asset. My new ratio will be, current liabilities will not be impacted, it will decrease. Okay. Then, 1 month forward buying rate for dollars. I'm sorry, with this chapter I got a little messed up with the questions here and there. We are required to calculate 1 month forward buying rate. Now, always see over here, this is your question, right? 35 to 32, it is decreasing. That means the currency is at discount. Now, if it is at discount, 1.2180, 1.21, the last digit is represented by 90. Now, just write your digits over here and put 0. Start from the reverse order. पीछे से शुरू करना. You have the answers. $1.2145. Now they are asking buying rate. That means bank will buy at a higher rate or a lower rate. So it will be 1.2145 because buying rate is always less, selling rate is high. This is buy rate, this is selling rate. Okay, do not get confused. Then 2 months forward rate. Okay, this is same, it is discount. Let's say reverse it. I'll change it. Then it is same only. 70, 72. Now, is it increasing? If the forward margin is increasing, what are we supposed to do? We are supposed to add it. Correct. Same value. Now, instead of subtracting, what we will do? We will add it. Correct. 1.2180, 1.2190. So, 7072. Now see, bid and ask both they have right. Bid is your buying rate, ask is your selling rate. We can calculate it. 1.2180 plus 1.225 you're also getting the same answer, kya? Acha, because the question options are with respect to decreasing one, so it could be different. Okay, because here it was subtraction one, no? The question, original question. 1.2262. This is my buying rate, this is my ask rate. Correct? Then calculate the forward points. If the interest rate differential is 4%, they can also ask you forward rate. We can do that. Now, what will be my forward points? The formula is spot rate into interest rate differential upon 100 into days divided by year, number of days in a year. So, spot rate is 1.80. Interest rate differential is 4% and the forward period is 90 upon 360. Why? Because it is said to be taken 360. By increasing and decreasing, ma'am, see 70, 72, it is increasing. 35, 32, it is decreasing. So, 1.80 into 4% into 90 divided by 360. 0.0180. Now, can you calculate the forward rate? This is forward points. Forward rate is equal to spot rate plus forward points. Spot rate is 1.80, forward point is 0.0180. 1.818. That is your forward rate. Indraj Verma. Very good. Congratulations. You also have to say the same thing tomorrow. I'm not expecting anything else. Now, interest rate differential. See, if they ask you interest rate differential or interest parity, it is the same thing. Sometimes they reverse the question and it feels as if it is difficult, but it is same. Only we have to do cross multiplication. Now see, in this question, they have given forward points. Correct? How much it is? 0.0125. Spot rate is 1.60. 60 upon 360, but the rate of interest is missing. I upon 100. Right? So that you can keep it as X. So, 0.0125 into 360 into 100 upon 1.60 into 60 will give you interest rate differential or interest parity. So, 0.0125 125 into 360 into 100 divided by 1.60 divided by, wait, 60. Approximately 4.6875%, or if I round it off, though it is not asked, 4.69%. Correct? 46 again you have chance, right? Do not worry, you just need extra 4 marks. Okay. Then, now cost of debt, what was the difference? Instead of average, we will take the ratio of 60:40. We are almost about to come to the last area, right? If you like these efforts and if you want to put a like to this video, please feel free if you want to put. Then, so the same formula, the formula for cost of debt and cost of preference shares is same. Instead of this, if preference share is also asked, same formula, same method. Right? Now, a firm's debenture with face value of 100 and a coupon rate of 10% are a current market price. Okay. So, first we'll calculate their dividend would be given. Only that would be the difference. Correct? So, how much is the coupon? Redemption value minus purchase value divided by life. And in denominator, it will be purchase value or purchase price into 60%. Redemption value would be 40% into 100. Only this is the difference. Coupon rate would be 10 plus 100 minus 90 divided by 4 years. Now, purchase price is 90, and be very careful while solving this question. You should not mix up with 40 and 60, correct? That is really important. So, 12.5 upon 54 plus 40, that's 94 into 100. 12.5 divided by 94. 13.40, oh sorry, 13.2930. Correct? Then, cost of equity capital, you know it is very important. Just in the morning, I will also help you in revision. The morning session which happens from 5 a.m. Correct? I'll also help you in the revision of the same thing. Correct? Now, what is the formula of CAPM? Let's write down the formula. R is equal to RF plus beta into RM minus RF. Correct? This is directly the formula. Dividend growth model, P0 is equal to D1 upon R minus G, and earning price is earning per share upon expected earning per share. Let's say if they ask in question that the formula, and if they have written earning per share and then they have also written expected earning per share, you might feel that it is given wrong, same options are there. No, the difference is there. It is supposed to be expected earning per share. Correct? For example, here it is not dividend of current year. It means dividend of next year. One means year one. So, these things have to be evaluated very carefully. Dividend of next year. Okay? Now, if the risk-free return is 12% per annum and the expected return on market portfolio is 16%, what will be the required rate of return on a company's equity capital which has a beta of 1.50? I think max by 3 p.m. So, we know the formula R is equal to RF plus beta RM minus RF. If beta is missing in the question, we can also do it, right? Just transfer RF over here and calculate beta. We can do that also. So, risk-free return is given 12%. We don't have to do the calculation. That's not important. Plus minus you can do 12. Right. So, 12% plus 1.50 into 4. What is the answer coming? 18%. I'm writing directly if I'm just copying it. Correct? Then, earning price ratio. Now see, expected earning per share. It is given now, so do not get confused. It should be expected earning per share. That is 15. What is the current market price? The present market value of share is 100 into 100, 15%. Correct? Now, if the present market value of rupees 10 face value equity share is 100, dividend expected in year 1 is 10% and the expected growth rate is 4%. What is the required rate of return? So, P0 is given 100, D1 is given as 10% of face value, which is rupees 10. Growth rate is how much? 4% every year. So, the formula is P0 is equal to D1 upon R minus G. So, P0 is 100, D1 is 1, R we don't know, that is something we have to calculate, and this would be 100 into R minus 0.04 is equal to 1. %, है ना, 5 upon 5%, correct? Done. Hardly 10 minutes. 10 minutes. Not 10 minutes. More than 10 minutes. I think max by 3. Now, we have to calculate weighted average cost of capital. Now, how do we calculate weighted average cost of capital? Equity, preference, debt, 40%, 10%, 50%, right? This is the weightage or proportion. This is the cost, 20%, 15%, 10%. So, if we multiply weight into cost, %, 1.5%, 5%, correct? The weighted average cost is 14.5%, right? It is there only. Ashirvad is there. If you ask my heart, I will go and give paper for each and every one of you. Now, you are required to calculate the flotation cost. Now, flotation cost, you remember, revised weighted average cost. I explained you know the concept that how my actual or revised weighted average cost of capital would be different from the weighted average cost that I have calculated, because I will not receive 100% of the funds. Some funds would go towards the cost, raising the cost of capital. So, the formula is weighted average cost divided by 1 minus flotation cost. Correct? So, if my weighted average cost is 14%, 1 minus 0.05, that is 14% divided by 0.95, whatever the answer comes. That's 14.74. Correct? Now, capital budgeting. A project costs rupees 5 lakh and yields annually a profit of rupees 80,000 depreciation at the rate of 12% per annum, but before tax of 50%. Calculate the payback period. We are just about to end this session in 10 more minutes. This is the last chapter for numericals. And I would request all of you, honestly, please go and take some rest after this. Calculate the payback period. The marathon session will start in the evening, bilingual or English medium, both. It will start from 6 p.m. Now, calculate the payback period. So, the formula is outflow divided by cash inflow. 6 p.m. to 10:30ish. We will not stretch because we want you to rest. That's one thing I and Aarti ma'am, we strongly believe that a good paper needs a well-rested brain. We strongly believe in that. Fortunately, we both believe the same thing. So, yields annually a profit of rupees 80,000 after depreciation. So, profit is given after depreciation, but do remember, in the entire capital budgeting, we need cash flow. What is cash flow? Profit after tax plus depreciation. Correct? So, profit after tax is given. Oh, before tax is given, sorry. So, first you'll have to calculate profit after tax. Profit before tax is 80,000. Correct? So, minus tax, which is at the rate of 50%, profit after tax would come as 40,000. Now, what is the amount of depreciation? It says 12% per annum. So, 5 lakh into 12% will be 60,000. So, I'll have 1 lakh. It would be 5 years. So, I will be able to get my amount back in 5 years. In case of payback period, the duration will be better. The payback period, the project will be selected which has shortest payback period, right? Now, calculate payback period in the case where the cash flow is not same every year. It is changing. So, first I'll do the cumulative cash flow. 40,000, 1 lakh, 1,40,000, 1,90,000. Now, my outflow is how much? 1,50,000. So, somewhere it will land in this area. Correct. So, the difference is 10,000 that I will recover from the cash flow of next year. So, 3 point how many years? 3.2 years. Correct? .2, not 0.2. Then, ARR is which method? ARR is profit centric method. Correct? See, payback and ARR, very important from capital budgeting. If they are asking a numerical, the high chances you might get from ARR or payback. You know that question whose answer is 5.71. That's one of the most important and most repeated question. Answer comes as 5.71 years. But do solve the question. Just don't write 5.71, you know. If the values are changed, then what would happen? Now, what we will do, average profit, average investment. So, my average profit will be, I'll add all of them, 52 plus 56 plus 59 plus 57 divided by 4. Average profit is 56,000. The machine is 16 lakh. So, average investment will be 16 lakh minus 0 divided by 2, that's 8 lakh. So, 56,000 divided by 8 lakh into 100. I have added all of them, correct, and the total I have divided it by 4. So, 2,24,000 divided by 4 will give us 56,000. %7% we are getting, no? Then, calculate the NPV of the project. How do we calculate the NPV? This is the second last question. NPV, net present value. Not bad. 1.5 hours we have completed all the numericals. Approximately, I'm sure 90% numericals we have completed, 95% numericals. So now see, whenever it is about NPV, how do we calculate? NPV is equal to total present value of future cash flow minus outflow. Correct? Now, 55 present value factor is given 0.909. So just keep multiplying this with this. 4995, 80,000 into 0.826, 66,080, 15,000 into 0.751, 11,265. Total is coming as 1,27,340. How much is my investment? 1 lakh. My NPV would come as 27,340. It is positive. When it is positive, I will accept it. Okay. Positive NPV will be accepted. And in case of mutual exclusive event, if the NPV is the highest, we have to select that one. Okay. What was the problem with IRR? Remember why I have given all options wrong. 27,340. I hope I have done this right calculation. No, you are also getting the same. 27,340, right? I've done something wrong. Just let me know once. Next. Maximum permissible bank finance under the first method of lending. Cool. Now, what is the first method? First method says working capital gap 75% will be bank finance. And margin money will be working capital gap into 25%. Correct? Second method says that total margin money will be total current asset into 25% and my maximum permissible bank finance will be working capital gap minus total current asset into 25%. Now, what is working capital gap? Current asset minus current liabilities excluding bank borrowing. So, here 370 minus 150 will give me 220 and they are asking me maximum permissible bank finance and multiplied by 75%, that will give me 165 lakh. Now, okay, yes. Correct? Now, if my current bank borrowing is 200 lakh, how much surplus or excess limit I have right now? 200 lakh minus 165 lakh. That means 35, right? Done. I hope you have found this session useful, at least a quick revision, whatever I could do. And if you like this session and if you want the PDF of this session, click on the like button, subscribe the channel. We will keep bringing things for you that are important, correct? And like definitely motivates us and it also reaches maximum people. Third, you can also get this session immediately whenever you want. It will be saved in your like videos. Once the exam is over, whenever you are not in need of this video, you can go and you can just remove that like thing. So it will be out of your list. Okay, so like video has 3 benefits, not 1 benefit. Correct? Now, the next session, the Telegram link has been shared. You can join. I'll upload the PDF as soon as possible. I'll have to save it and I'll have to send it to Telegram group. I'll do it immediately. If you're connected in WhatsApp also, I'll send it in WhatsApp. So PDF will be provided. It will be sorted in next half hour maximum. I would request you to take rest and come back sharp at 6 PM to join us. Okay. I and Aarti ma'am will be taking Maha revision session at 6 p.m. and in morning 5 a.m. we will start with, again a revision session that is at 5 a.m. These are the most important formulas. Like, see, numerical questions, they vary. Sometimes they're asked, sometimes they're not asked. So I will be just uploading this PDF. You can have a look at it maybe today or tomorrow in the morning before exam. You can have your time, right? I hope you enjoyed the session, and we'll meet today at 6 p.m. Now go and rest. Your rest is really important so that you are totally active in the evening. Thank you for giving your valuable time. We'll meet in the evening. Bye-bye. Take care.